If you bought Jubilant FoodWorks above 600, please watch this full video. 2 weeks ago, this company said profit went up 67%, revenue was the highest ever, but the stock fell by 8% on the very same day. Profit went up, stock down. That should not happen generally. By the end of this video, I'll show you the real reason, one number hidden inside the report that most people are not even talking about. Stay with me because the real story is much bigger than the stock fell. And before proceeding ahead, please do subscribe the channel so we can reach 1000 subscribers. Now back to the point. Quick reason why we are making this video. On this channel, we don't follow random trending stocks. We follow only one thing: companies with a moat. A moat means no other company can copy this advantage even if they spend a lot of money trying. Jubilant FoodWorks has a very strong moat. It is the only company allowed to run Domino's Pizza in India. Not a license, the license. Zomato cannot become Domino's. Swiggy cannot become Domino's. No new company can become Domino's in India. Only Jubilant FoodWorks can. Remember this point because we will come back to it later. Let's understand the full picture first. Jubilant FoodWorks, the company that runs Domino's Pizza in India, was trading near 790 in early 2025. Today the price is around 420 to 440. That is the fall of 45% in about 1 year. In simple term, if you put 10 lakhs in the stock at top, today it is worth less than 5.5 lakh. The 52-week high is 720 and 52-week low is 409 right now. The price is very close to that point. 22,000 crore of value is gone. And here is the strange part. Revenue was growing up every single quarter, a new high every time. So this is not a story of a business shrinking. Something else is going wrong, and let's find out what. Here is the clue number 1, and this happened 2 years ago. In financial year 2024, Jubilant's profit was 400 crore. In financial year 2025, just 1 year later, profit fell to rupees 217 crore, a 46% drop. But in the same year, sales went up by 44% from 5,600 crore to over 8,000 crore. Read that again. Revenue up by 44%, but the profit is down by 46% same year. This is the real reason investors stop trusting the stock high price, and it's happening long before this year's bad result. Profit has now only come back to around 411 crore, which means it took 2 full years just to reach the same profit level as before. Now remember the number I promise you. Here it is. It is called same store sales growth. In simple word, how much more money is an old Domino store making this year compared to last year. We are not counting new store, only old ones. In quarter 4 financial year 2026, this number for Domino's India was just 0.2%, almost zero growth. Before this, for the first 9 months of the year, this number was healthy 8.5%. Management gives some reason. Last year's same quarter was unusually strong at 12.1%, and there were LPG gas supply problem in March that hurt sales a little. Fair point, but here is what nobody is telling you clearly. Jubilant opened 59 new Domino store in India in the same quarter. So if old stores are not growing, where is the extra revenue coming from? New stores, not more demand from customers. This kind of growth can hide a problem for some time, but it cannot hide it forever, because for the market champions, growth cannot be compromised. Now let's add the cost problem too. Gross margin in India was fine, 75.5% in quarter 4, even slightly better than last year, but operating margin before some accounting adjustment was stuck at around 12% because the cost of dairy, oil, flour, wages and energy all went up, and menu prices did not go up as fast. Management says margin will improve by 200 basis points. That simply means 2 percentage points by financial year 2028. But Jefferies, a big research firm, does not believe this timeline, and they have already cut their profit estimate by 10 to 12%. Now here is something that worries me even more. Look at the last 10-year return on capital employed, which shows how well a company uses its money. It used to be 30 to 40%. Today it is only around 13%. Return on equity last year was just 10.4%. This is not about one bad quarter. This company has been using its money less efficiently for almost 10 years now, even while opening more and more stores. That is very important. Now, here is something most people get wrong about this stock. You will see charts showing Jubilant's debt going up a lot, and it looks scary. In financial year 2019, the company had zero borrowing on paper. In financial year 2020, this suddenly became 1670 crore. Did the company take a huge loan overnight? No. A new accounting rule called Ind AS 116 came in that year, and this rule says companies must show their store rent as liability on the balance sheet. It is just an accounting change, not real new debt. But after that, borrowing kept rising past 4,500 crore by late 2025, and some of this is real new debt. Money borrowed for buying DP Eurasia in Turkey, for Poppies and other deal. So what should you actually watch? Interest and depreciation, these are very important number. This number hit real profit no matter what the accounting shows. Interest cost was around 201 CR in financial year 2023 and 523 CR in financial year 2025, more than double in just 2 years. Depreciation went from 486 CR to 807 CR in the same period. This is quietly eating into profit even when EBITDA looks healthy on the slide. In March 2026, Jubilant said that they will not renew Dunkin's donut agreement in India after December 2026. Dunkin was only about 0.5% of its total revenue and it lost 19 CR on just 37 CR of its sales in financial year 2025. 15 years in India and it never became big, not even once. This is not really a story of donuts. It shows that the company's multi-brand plan did not work everywhere and now they are putting their money into back what is working. Domino's, whose license was just renewed for 15 years plus an option for more 10 years. Remember what I said at the start, that is the moat and it just became even stronger for up to 25 more years. No other company can compete for this license, not for many years. But this does not fix the same store sales problem, but it gives the company time to fix it because nobody can take this license away in the meantime. And Poppy's same store sales growth of 28% in financial year 2026, growing towards 100 stores. Here is one more thing almost nobody talks about. Foreign investors have been slowly selling this stock. Their share went from almost 28% in December 2023 down to just 17% by March 2026. At the same time, Indian mutual funds and insurance companies did the opposite. Their share went from under 22% up to 36%. Foreign money is leaving, India money is coming. This is not just a retail talk. These are the two big of professionals with two different opinion on the same stock. Now the most important part. After falling 45%, is Jubilant FoodWorks actually cheap? Let's check the number. The PE ratio. In simple word, how much expensive the stock is compared to its profit. It is between 65 and 90 times, down from an average of more than 110 over the last 3 years. EV to EBITDA is around 17 to 18 times, down from almost 30. Price to book value is around 12 to 15 times. Now here is the real question. Return on equity last year was only about 10.4%. Does this price make sense for that kind of return? When you pay 12 to 15 times of book value, you are betting that this company will earn very high returns for many years. In India, a consumer businesses usually needs return about 12% just to be worth that price, and 10 to 14% is barely enough. In the good case scenario, margin improve as promised, Poppies grow fast, return go back to high teens, then this price is okay. The bad case, same store sales growth stays near zero, margin keep disappointing and the price keeps falling closer to where Westlife and Devyani trades. And here is the interesting part. Even big research firms cannot agree. About 30 analysts have given price target and they range from 460 all the way to 850 with an average target price of 650. This is one of the widest range you will see for any big consumer stock in India. In simple words, nobody really knows which story is true. Not even the expert who are paid to know. So, is the stock undervalued or overpriced? Here is one thing to remember. The moat is still safe. Nobody can take Domino's away from Jubilant. That part of the story is fine. The real question was never about this moat. It was about whether you are paying too much right now for a moat that is going through a tough time. It is cheaper than before, but it is not cheap yet by the numbers. This fall was on same store sales growth near zero, margin not improving as promised, and profit just came back to where it was 2 years ago. What is good about this company is a fresh, renewed Domino's license, better cash flow, and Poppies as a strong second business. But is that enough to justify paying 12 times book value? That decision is yours, not mine. If you bought about 600, like I said at the start, now you will know exactly why your portfolio look like this. Thanks for watching. Please do subscribe the channel so we can reach 1000 subscribers. See you in the next video. Take care. Bye bye.